really do appreciate it. I'm happy to see we have some board members here today. We have, a lot of our management team as well, some credit union staff members. So thank you for everyone, of course, who took some time. My colleague Ann and I are excited to receive two guest speakers from Aviso Wealth and NEI Investments. As you already know, KCCU Wealth Solutions, our wealth management office, is owned by Kingston Community Credit Union, and we wanted to take this opportunity to strengthen our relationship with our other credit union partners. And so they will both speak, to what those relationships are tonight. Matthew will be speaking on behalf of Aviso Wealth about private wealth solutions. Aviso Wealth is the wealth management firm serving credit unions across Canada. It's owned by Desjardins as well as the 5 provincial credit union centrals and the Cumis Group. He can give you more details on that. If you and Joel is speaking on behalf of NEI Investments, a leader in responsible investing for over 35 years. Your KCCU folders, and I believe there's kind of 2 different versions. So one, if yours only has the NEI private portfolio version, then I can come over and give you this version as well. This is what the bulk of the presentation will be, regarding Aviso Wealth, private wealth solutions, and NEI responsible investing. So if yours doesn't have that, there's a few up front here that I can kind of walk around and give away. And so this is NEI's focus list for 2023. It's active ownership program. And so please be sure to take that home with you. There's a note section if you'd like to take some notes and ask some questions. We'll be holding a question period after the both of the presentations. So please use that as a reminder for any questions. Yes. We're recording them right now, and we will, for anyone who is interested in receiving the recording, yes, we're happy to send it your way. Oh, the PowerPoint presentations? I don't think so, because I think they're owned by the companies themselves, yeah. Okay, so without further ado.
Well, thank you, Evelyn, and thank you everyone for making the time tonight. Appreciate it. Like Evelyn said, I'm here representing Aviso Wealth. So just a high level, Aviso is over $100 billion in assets under administration, and we, as Evelyn said, cover 150 credit unions across Canada. So that gives us an enormous scale and opportunity to provide you with the highest quality wealth management in the country. So before I tell you a little bit more about that, I wanted to talk a little bit about a couple things tonight. The first thing I wanted to talk about was, where are we right now? What's going on in the market? What's going on with gas prices? Why is meat so expensive? And we're going to go from there into a couple stories from my own personal experience that I've had with family members. And then from there, we're going to, again, a little bit about Aviso and so on. So I put up these 2 charts, and don't get confused. Don't even look at them. I'll just talk for a little bit. I have inflation and interest rates here, and those are the 2 things that have really characterized the last 3 years. So I got a phone call from a friend of mine in January of 2020. Called me up. I was still in university at the time. Was writing my final thesis. And he said, Matthew, have you heard about this virus out of China? And I was like, oh, here we go. I would consider him a bit of a conspiracy theorist. So I was kind of rolling my eyes. And he said, oh yeah, there's cases in Europe, there's cases in the US, it's spreading like wildfire. It could affect the markets. And I'm like, what's going on here? 2 months later, everything was canceled. Campus was closed, lockdown at home, finishing everything online. Like, the world shut down. Everyone had to work either from home, if we were able to, or we had to make do otherwise. Right? Restaurants closed, bars closed, hair salons closed. My girlfriend was affected. She had to cut hair from home. She had to get a part-time job, not in her field. So businesses lost a lot of their workers, quality workers, right? And while people were at home watching Netflix or watching, TV this entire time, they managed to save a lot of money. Right? It's difficult to spend money when you can't get on a plane and you can't have to wear a mask in the grocery store, and ended up not doing too much, right? So over this period of time, people saved up a lot of money, and over the same period of time, supply chains shut down, pretty much. Everything reopens all at once. Now we have an army of people with bank accounts like this and goods and services like this, right? What does that lead to? Inflation. Prices go up, right? That's why meat's so expensive. That's why gas is so expensive. Because through this period of time, everybody was able to save money. Prices were falling, goods were scarce, and then all of a sudden the world reopened and everyone couldn't spend fast enough. Now, that's good because that means the economy's growing, right? People are out spending money, that's great. But the problem with that is once inflation gets out of control, it's kind of like a genie coming out of the bottle, and it becomes a cycle. And people that have lived through the 70s and 80s know how that can become. Right? Once that whole decade, we had 5+% inflation for about 10 years, and it's very difficult to stomp it out. So how do you get rid of inflation? Raise interest rates, right? It's a pretty blunt tool, but it works. The problem with raising interest rates is that it slows the economy, right? It doesn't just slow inflation, it slows everything, because we have to stop people from spending. So that's where we are. Everything's expensive, but interest rates are high, right? And if you're entering into retirement, going into retirement, that's not a bad thing, right? You probably like high interest rates. It's new, it's welcome, because they've been low for almost 20 years so far. Too low. So that means there's opportunity in the bond market. Now this is another confusing slide, but I won't labor it too much. I just want to emphasize when you are using a guaranteed product, like a GIC, for example, the real return that you'll experience after tax is going to be negative. After tax, after inflation. Because like I said, inflation was rampant. Inflation was 6% over the last year. And the year prior, GIC rates were only 4. So your nest egg is like a melting ice cube. Because you're earning interest, it's just melting a little bit slower. Right? So what can we do to get ourselves out of this hole? This is my grandfather, Rivoli Isolero. He's been teaching piano in Niagara Falls for 75 years. I was with him on Sunday for his 92nd birthday. He's still going strong. He's managed to convince his doctor that it's okay to drink wine as much as you want. And so we went out for dinner, we had a nice cake, coffee, spent some time together. And in chatting, he was telling me about how expensive the cost of living is for him. He was telling me about a tenderloin from Costco that used to be $100 like this, now it's $200. He was telling me about how he can't find someone to open and close his pool and put chemicals in it. He got quoted $3,800 for that, for the season. And so, of course, this conversation lends itself to, he's a piano teacher, he's no finance guru. But we got onto the conversation of, what are you doing with your money, right? How's it being invested? He said, well, Matthew, as soon as I retired, when I was 65, quote, retired, he never really retired, he's still teaching piano. But when he stopped working full-time, his advisor put him in GICs only, right? So now, fortunately, he's managed to live to 92, almost 30 years after, quote, retiring, right? This is a good thing, but now he's starting to get a little concerned because the cost of living keeps going up. His investments aren't performing the way he hoped. And now he has to cut costs in basic living expenses. Opening the pool, right? He's not going to stop drinking wine though, I already asked him. But the whole point of what I'm sharing is that you're probably gonna live a lot longer than you think. If you're 65, statistically speaking, and this is for ladies tend to live longer. If you're 65, you can expect to live to 89. Because when we're born, our life expectancy is 80, 82, roughly, Canada. But, you know, if you've made it to 65, that means you've managed to avoid all the potholes along the way, right? You didn't get hit by a bus, you didn't have a stroke, etc., right? So now that you're 89, that's just the base expectation, right? People live longer than 89, right? So the point of what I'm saying is that if you're 65 right now and you're thinking, oh, I'm gonna retire, that means I need to be very conservative with my investments. No, not at all. Your time horizon is 30 years if you're entering into retirement right now. Retirement's a process, not an event. So over that period of time, you wanna make sure that your investments are keeping up and hopefully beating inflation. And I put up this chart just to illustrate one simple concept, and that is, from one year to the next, we don't know what's gonna happen in the market. We could have a COVID, we could have a rise in interest rates, we could have, you know, a bubble, who knows? But over a 5-year, a 10-year, a 15-year period, we know exactly what's gonna happen in the market. It's gonna do exactly what the economy does. Right? People wake up and go to work in the morning, they pay their taxes, they buy gas, they put food on the table, they get a job. That's what drives the markets. However, there's volatility along the way. So for better or worse, you know, in the case of my grandfather, it was for better. Okay? He doesn't have as much as he hoped he would in retirement. In the case of my grandmother, whom I don't have an image of, but a month ago she had a stroke. This is my grandmother on my mom's side. She had a stroke and she's been recovering in the hospital now for a month in Oakville. She's lost a lot of mobility on her right side. She can't walk very well. My grandfather has had to now sell her car to pay to renovate the main floor of their house, to take the carpet out, to put a handrail in, to widen the doors, to put a chairlift. And fortunately, my aunt was able to quit her job and be full-time caretaker for her. Right? Now, if that wasn't the case, it would have been a very expensive proposition. So for better or worse, neither of my grandparents had as much as they needed. So the title of my presentation was Beyond GICs. And so this is what I wanted to emphasize, was that even at 5%, a GIC is great. Right? But because interest rates are high today, we can't count on the fact that they're gonna continue to be high over the next 3 and 5 years. Right? Interest rates have been very low for the last almost 20 years, since 2010. 15, anyway. Assuming an extra 2% return in a balanced portfolio of stocks and bonds, that same amount of money, in this case $500,000, would last an extra 12 years. That extra 2% will take you more than a decade further into retirement. Something to consider. So I mentioned at the beginning of my presentation that I'm representing Aviso. Again, Aviso is the basically the central dealership of some of the largest credit unions in Canada. We are jointly owned by the Cumis Group, the Cooperators, and Desjardins, and collectively manage over 110 billion in member AUA across the country, serving 150 credit unions. We have a number of arms of investment and financial services. We have Aviso, our private wealth solutions, which I represent. We have NEI Investments, with Joel is here to represent. We also have our direct investing platform, Q-Trade, which is a discount brokerage. And we also have our correspondent and institutional network. So collectively, we work with almost all of the credit unions in Canada, providing scale and scope and diligence for your investment products. So very briefly, I'll touch on private wealth just in the interest of time. So what is private wealth? Private wealth portfolios are going to get you that extra 2% over time. They're going to get you a complete, fully diversified investment portfolio with stocks, bonds across a global portfolio as well from around the world. It's going to give you active management. So some of the highest quality asset managers, not just in the country, but in the world, are on this platform. And that scale that we have, like I mentioned, that $110 billion, you're not just investing with, KCCU is a smaller credit union, but that's not the limit of what's available to you. What's available to you on this platform has the scope of the entire nation. It competes with bank platforms and any other dealership, Richardson, anything you can go to. It's also transparent and exclusive to the credit union partnership. I'll say that it's transparent in the sense that you can directly hold stocks and bonds in your name on your statement. It's exclusive in the sense that it's proprietary to the credit unions. We do not offer these products to anyone else. You can't go to the bank and get them. They're only available to our members. And finally, they are accessible. The other interesting piece about them is that usually to get the same quality of asset management that you're going to get with the private wealth platform, you're going to need at least $1 million. You're going to go and knock on the door of Addenda or Fiera and say, please manage my money. And if you don't have $1 million, they're going to shut the door on you. Here, because of our scale, it allows us to offer the same products with a lower entry threshold. So without going into too much depth on the managers, I'll briefly touch on the three options on the platform. There's on-point pooled investments, which have this is actually a $50,000 minimum. We reduced the minimum. $50,000 minimum, so these are pooled funds, very similar to mutual funds. We have our on-point managed portfolios where you directly hold equities, so stocks of different companies. We're talking about CN Rail, TD Bank, Loblaw. We're talking about businesses that you can know and understand, right? Businesses that have very strong moats. They have very established positions in the market, and they're not going anywhere, right? You think about like an Enbridge. You're gonna stop paying your gas bill? Is anyone gonna stop paying their gas bill?
I wish.
Yeah, I wish too. And on the fixed income side, we're holding very safe fixed income. We're looking at Canadian government bonds, right? And the only way you're not going to get an interest payment for the Canadian government is if everybody stopped paying their taxes. My grandmother said, Matthew, there's two things that are certain in life, death and taxes. So you can know holding those fixed income instruments, you're going to get paid no matter what. And then finally, our highest threshold for management is our credential managed accounts. One of Canada's top 5 separately managed account platforms. It's growing very quickly. Collectively, we have $5 billion on the platform. So this is a portfolio where you will hold every single security individually. Stocks, bonds, everything. You'll have 100 items on your statement, for better or worse. If that's something that you're interested in and you want to have that transparency with your investments, see every dividend payment, see every interest payment, that's available to you. And only to our credit union members. This is available to you, for you, by you. It's a member exclusive product. I'll just briefly mention one of our managers, Addenda Capital. So Addenda is based out of Guelph. I've met with one of the portfolio managers, David Johnson. He's a great skier, and we go for lunch every once in a while. He's a great guy. Addenda actually manages the pensions of the University of Toronto, the University of Guelph, the City of Toronto, the City of Calgary, and the City of Saskatoon. So they're a huge Canadian manager, locally based. I mean, I could throw a stone to Guelph where I live. So that's having that peace of mind and knowing that some of the largest institutions in academia and public service in this country have entrusted their wealth with these managers will help you sleep better at night, knowing how it's being managed, the quality of the management. And Addenda is not just a great asset manager, they're great in the way that they manage assets. They do it with a responsible, impact-based philosophy, right? They're looking at the quality of the business, not just from if they're making money, but if that money making is sustainable in the long term. So before I continue talking and go on a rant, I guess I'll cap it off there and pass it over to my friend Joel Robinson from NEI. If there's any questions, maybe we could leave them to the end, or I can take some now if you have them. Thank you.
Are there any burning questions for Matt before we get going? No? All right. So up next, we're going to talk about bonds. No one's laughing, but just kidding. I don't think people want to hear about that for the next 20 minutes. We're going to talk about responsible investing. And when I've done these kinds of presentations in the past, it's great to be doing them in person again, by the way. You just really don't get the same engagement over a computer screen. So haven't done this in a while, but everyone raise your hand right now if, I'm assuming that either you're a member of the credit union or thinking about becoming a member. Do you invest responsibly right now?
Can I do this?
Okay, so there's quite a few. Everybody else put their hand up, assuming that you have a job or have had a job and have contributed to CPP. This is something that is front and center with what CPP is doing and what some of the largest investment managers around the world are doing, because ignore the politics, ignore the noise. This isn't about being woke or values-driven investing. Certainly that could be part of it. But CPP's main mandate is to run a sustainable pool of capital. And so thinking through that lens is cornerstone to what they do, and arguably they are one of the top institutional investment managers in the country. So we'll walk through NEI's process and a little bit about why we think that it's important. But just to set the stage for a brief agenda today, we'll give a baseline definition of what is responsible investing. There's so much different stuff out there: SRI, ethical investing, green investing, sustainable investing, response. What does it all mean? I'll tell you, and it's a lot of noise and in some cases clever marketing. And then we're going to talk about how does our responsible, in NEI's opinion, make better investing. So we prefer to call it RI. I personally don't even use the words ESG. I think they've just become way too politicized. And then the question that I've gotten before is, well, that sounds nice, but can you actually make a difference, or is this just sort of lip service? So we'll talk about the notion of impact investing and active ownership, which is something that we have a whole team at NEI that specializes in this. Talk a brief bit at the end about how, from a portfolio standpoint, NEI takes all this and brings it together. And then we'll take some questions. Hopefully we have some time. And if there's any questions about the markets, you can ask me and Matt, and we'll see who gives you an answer you like better. So one other question that I like to ask as well: NEI is an investment management firm, and the reason that we're all here today is because we're investors. And the main goal of being an investor is hitting your financial objectives and your financial goals. And assuming that is taken care of, if in addition to that you could also make somewhat of a positive impact on the world, environment, society, raise your hands. Like, is that something that you'd be interested in doing, assuming that you're still making money in the process? I think everyone's hand went up. That's good. So keep that in mind. And as I mentioned, I'll start with a brief definition of what is responsible investing. And not to read off the screen, but you see where the main thing that I focus on here is sustainable value. And I use that example of the Canada Pension Plan. Their main mandate is to run a pool of capital that, when Matt and I retire, I hope it's there because we've been paying into it. And so if you look up the word sustainability and forget all the noise around it, just looking up the strict definition of it, it means something that's going to be around in the future. And when it comes to responsible investing, we think about this through the lens of looking at things like environmental, social, and governance concerns, or issues, opportunities, risks, things that are lumped into those buckets that you might not uncover the full picture just looking at earnings reports, balance sheets, financial statements. So to give you a quick overview of the E, the S, and the G, and I know I said I hate using those words, environmentally. Every July 1st, now we're trying to make sure we fill our cars up the day before Canada Day, because there's a C word, the carbon tax, that's going up every year. And you can all think of companies that, for example, if they have zero regard for the environment, communities they operate in, number one, there's government regulation that's going to be making it more difficult for them to do business and get access to capital. And then not to mention turning off a certain segment of investors and shareholders, consumers that are just not going to want anything to do with that. We have very carbon intensive sectors here in Canada, the energy sector being one of them, and I'll talk about that in a minute. And even the energy companies are all laying out plans to start to move a little bit over to renewables. How can we reduce our carbon footprint to think about this stuff? So this is why it's important to think through that lens. On the social side, imagine you pick up the newspaper, or these days everything's on an app, and you look and you see a news article on the front page of a company that you own in your portfolio, and it's bad headlines, like they've got forced labor, or they've been exposed for something like that with their labor supply chain. You can only imagine what that's going to do to the stock. And then lastly, governance. I don't know about you, but I think that good, honest, integral board of directors and oversight within a company, that's not about being woke, it's just running a company properly. So I guess where I'm going with this is responsible investing, at least how NEI looks at it, is taking everything that traditional financial analysis would do, looking at earnings reports, balance sheets, all sorts of different financial statements, and then also looking at these things through that E, S, and G to uncover areas of opportunity, and then also tilt the portfolio away from certain risks that might not be uncovered with traditional financial analysis. And so when you pair the two, we think that just leads to a more informed decision as an investor. Now, this is a busy chart, and this isn't just NEI talking about this. This is showing what what's called the United Nations Principles for Responsible Investing is. And it's a term that probably not many may or may not be familiar with. But all it is back in 2006, a group of investment management companies. So think about the NEIs, which, by the way, NEI was a founding signatory back in 2006, so we've been doing this for a long time. Don't quiz me on this after, I don't remember off the top of my head, but think about names, just to name a few you might know: BlackRock, Vanguard, Fidelity, TD, RBC Mutual Funds. I don't know exactly when they joined, you can actually look it up. But companies like that got together in 2006, and they signed on to the first Principles for Responsible Investing. And all that is it's just a baseline of standards that these investment managers are going to follow to incorporate some of those ESG or responsible investing pillars into their investment research. So you can see on the left side there, very few number of managers that have actually signed on to this. And in recent years, that's only going to 2020, but it kind of does a bit of a hockey stick. And I can tell you right now that any credible investment manager around the world, and certainly here in Canada, that's something that they've signed on to. So this is not just something that NEI is thinking about. You know, I gave the example of CPP. This is something that, in varying degrees, all of the biggest money management companies around the world are incorporating into their investment process. Fast forward to today, I mentioned that NEI was the first company, one of the founding signatories of this. Fast forward to today, I like to tread lightly on this because we're not just a responsible investing company. We're an investment company, as I mentioned at the beginning, but we do have the most assets in Canada for responsible or sustainable investing. So if this is something that's important to you and you'd like to learn more, definitely you can ask me while I'm here. But Ann and Evelyn, I know, are both experts with the NEI lineup. But this is something that, as you can see, and they're not labeled on there, but all the banks, large independent mutual fund companies, this is something that they've been kind of scrambling to catch up on, and for now it's nice that we still have the largest amount of assets in that space. This is, you probably can't see what's on the bottom, but every year the UN's PRI, they do an assessment. Remember when I showed the chart of everybody becoming signatories for this? Every year the UN PRI does an assessment of, just because you sign this, like, are you actually doing this? And some companies are, some are kind of doing it, and others, frankly, are really not doing it at all. But they do an assessment every year, and you can see that in the lighter blue, NEI outperforms the median in all sorts of, across all the categories. So this covers things like proxy voting, equities, listed equities, fixed income, and across all the different areas. So I want to spend a bit of time, you say that's great, Joel, but like, what exactly is this? 20, 30 years ago, the term SRI kind of came out. And this is what, when in my everyday career, I'm working often with financial advisors, portfolio managers, investment advisors who tend to be 50, 60 years old. They've been doing this for a long time. And 20, 30 years ago, responsible investing, it was expensive and the returns were not good. And that's very much changed right now. The reason why it was not such good returns back in the day is because all they were doing was just screening things out of the portfolio and taking things out like tobacco companies, for example, weapons manufacturers. There's really not a whole lot of value that's being added by doing that. It might morally align with certain people, but that's table stakes right now, and you certainly don't need to pay an investment firm to do that. There's basic quant models that can screen that stuff out. Where the industry is right now, and most of the assets in this space in Canada reside, in terms of like mutual funds and portfolios, it's what we call ESG integration. And really all that is the portfolio manager who's in charge of picking the investments. They're looking to see, they need to be able to show, is this benefiting the portfolio from an opportunity standpoint, or by not owning this company or this industry, is it going to tilt us away from certain types of risk? The problem with that is when you look at a lot of ESG funds, in some cases, when you open up the box and what kind of stocks does this actually own, you can sometimes wonder, like, how is this ESG? And so that's where the term greenwashing comes in, and it's become very difficult to navigate through all this marketing and labeling. It's confusing. So where the true practitioners of this have gone, and NEI has the largest lineup of this in Canada, is impact investing. And in order to be labeled as an impact investment, you need to be able to show and quantify the outcome of what that set of stocks or bonds have accomplished. And I'll give you an example of what I mean by that in a moment. This is on the bottom half of the triangle, is all talking about investment stuff. On the top part, things like proxy voting and corporate engagement, I'll give a few examples of that in a moment. And NEI has an entire team which we've trademarked and named that our Sustainable Intelligence team. That's where the rubber really hits the road with responsible investing. And well, I'll give some examples, but when you own stock or share in a company, you're a part owner, and that comes with voting privileges. And when you run hundreds of millions of dollars like larger asset managers, it gives you a seat at the table too to talk to these companies about things. So that's a really high level overview of what exactly is responsible investing. Have I lost you yet?
There's coffee at the back.
Yeah. I hope I'm not being too dry. So here's a couple real life examples. How many people remember the BP oil spill? Or more recently, the SNC Lavalin scandal. These are examples close to home, and the BP oil spill, that's a prime example of an environmental misstep, and SNC Lavalin on the governance side. Now, I'm not saying that responsible investing is a silver bullet to avoid all of this stuff, but thinking about safety records with things like BP and what exactly are you checking and looking at, that's not going to show up in a balance sheet or an income statement. SNC Lavalin, like this, the governance stuff, like again, that's not going to show up in traditional financial statements either. So I might sound a bit high, but I wasn't around at the time with NEI, but we didn't own any of those stocks at the time. So an example of thinking through this lens, and maybe these were companies at the time that we did not want to own in the portfolio for those types of risks and reasons. So going back to the 70s, and when you looked at how companies were valued, so when an analyst or a portfolio manager, when they're determining what stocks they'd like to buy in their portfolio or in a mutual fund, they, back in the 70s, 80s, 90s, it was a lot of tangible hard assets. That's what derived the value of a company. So think about like physical infrastructure, buildings, plant, property. Fast forward to today, you'll see in the blue line, that represents intangible assets. And intangible assets, for those who might not be familiar with what that really means, they show up like on these financial statements for companies on their balance sheets, and they have massive amounts of value attached to them. And a lot of this can come from like their reputation, their brand value. So one example I like to use is, what's the biggest company listed on the U.S. stock exchange right now? The biggest company in the world. Take a guess. Who said it? Someone back there. And what does Apple do? Yeah, you're right. They're very genius. They have a genius marketing department. They can make you realize you want an iPad before it even existed. So they're very good at that. But a lot of the times, people will say Apple's a computer company or Apple's a phone company, and now watches and pens and everything. But Apple is a brand, right? And my point with this is, once you mess your brand up, it can be very hard to recover from it. And there's examples of companies that haven't been able to recover from it. And so thinking about these intangible assets and how that's driving such a big part of a company's value and ultimately how their stock price is doing, thinking about these ESG considerations is very important. So we talked about how you might be able to minimize risk, but what about the exciting stuff? Like, how can you make more money looking at things like this? Last fall, we hit the stat came out, we hit 8 billion people in the world. And that's about double from the 80s. It's on its way to 10 billion, I believe, by the end of 2030 or 2050, but it's projected to keep going up. And a lot of that population growth is happening overseas. And you can see some of these are just demographic trends that many investment firms are talking about right now. But the world's going to need more food, and we have way less farmers right now, by the way. We're going to need a lot more water, which the agricultural industry they use a lot of water. And then we're also going to need a lot more energy. And these are all three finite resources that, with more people, there's going to be more of a strain on this. So there's companies that are providing solutions to environmental problems to use less energy, to be more precise with agriculture, to use less water in irrigation. And when you look at what some of the best stocks to have owned throughout history have been, they're providing solutions to problems. And this is something that we all depend on: food, water, and energy. So the companies that are providing solutions to this stuff, they're growing their earnings at a higher rate often than the market, and in many cases their stock price is the beneficiary of that. So we talked about risk, opportunity, impact. This is a snapshot from one of our environmental funds, and this is showing a hypothetical investment of what you actually can accomplish with this. Now, there's some mutual funds out there that they might have impact or responsible or ESG in the name, and again, what is that actually? Is it even doing anything? Well, we show you what it does, and you can see approximately 1,000 tons of CO2 was avoided through investing in the companies in this particular portfolio, which equates to about 220 cars off the road. And then you can see the other numbers on the screen. So you can see the amount of renewable energy generated, the amount of water treated and saved, and then the amount of material that was recovered. So this is just one example of what I mean by an impact fund, where it's fine to say that you're doing something, but where's the proof, right? So for all of our impact-oriented portfolios, this is numbers that we make readily available. And now we can talk a little bit about corporate engagement. So I'm sure a lot of people recognize the names on the screen there. That's just an example of some big, well-known household names that we own through many of our different portfolios. And the slide's a bit dated, but this is from 2021. We're just getting the new numbers updated. But in 2021, we talked to 131 companies that represent stock holdings in our portfolios. And you can see that we voted on 11,000 proxies. So again, what that means is when you own a fraction of a company through their shares, you get a seat at the table, and you can also vote on matters related to that company. So this is something that some companies do, and investment companies do, and then others that they don't even do that. So, but again, what NEI is very transparent about is the companies that we're talking to, what we're talking to them about, and how that's been going. And Evelyn mentioned at the beginning that in all of your kits is something that we call our annual focus list. Thank you. And at the beginning of every year, we put this out, and there's generally about 4 areas that we choose to focus on for the year. And that will dictate the companies that we're talking to them about, or the companies that we're speaking with, the various industries that we're going after. And then we put out a quarterly report. So if you'd ever like to see that, please reach out to Ann and Evelyn as well. And we provide like a progress update on how that's been going. So a couple real life tangible examples for you. This is the one that always gets people going. Is NEI is a responsible investment company. Why do you own the energy companies? In some of our portfolios, we don't own them at all. And that's an individual choice that you as an investor have to make. If realizing that the energy sector is a very big part of our economy, it can become very difficult to completely avoid them. We have portfolios that don't own any companies in the energy space, if that's something that is of interest. However, we do own some of the energy companies in, let's say, our Canadian focused portfolios, because it's such a big part of the economy here in Canada. And the most important thing to realize is if NEI just says that we're not going to own them, there's overseas interests that have much lower standards and expectations that will scoop up and buy those stocks. And by having ownership, that gives us a seat at the table to talk to companies like Suncor and work with them on how can you remain a viable option in the Canadian economy moving forward in what's called a lower carbon society. So we've been speaking to Suncor for years, and often from a corporate engagement standpoint, it's not an overnight. You don't have one conversation and a company decides to just completely flip or change. But we've been talking to Suncor for many years and about reducing their carbon emissions, and they realize that they need to do this. This is the writing's on the wall. This is the way that the world's going. And in 2017, after years of us engaging with them and other investment companies also engaging with them, they set a target to reduce their carbon emissions by 30% by the year 2030. And you can see the chain reaction that had in the energy industry, with other big names, Exxon, Cenovus, also laying out similar plans. Had NEI just said, we don't want to own this at all, we wouldn't be able to talk to them about that, right? One other quick example, because I want to be respectful of time. CNR, CN Rail, that's another household staple name here in Canada. They had problems with their safety record, and they were having tons and tons of train derailments. And obviously it's not good from like a worker safety standpoint. There was environmental concerns after there was one that spilled 196,000 liters of oil into a lake, so not good from a PR standpoint, safety. For numerous reasons.
Probably not good.
Yeah, so you can see how that's not good. NEI was working with them and engaging with them, and we said, well, what if you link your CEO's compensation to the company's safety record? Guess what happened to the safety record? It significantly improved. So those are a couple examples of what I mean with companies that you know and understand of when I say corporate engagement, this is what we're doing behind the scenes. And again, there's examples of that in the pamphlet that you've received. And we put out those reports that I mentioned every quarter that gives an update on how that's been going. So I'll finish in the last couple minutes talking about how does NEI take all this and bring it all together. We're a mutual fund company, as I think has been alluded to, and there's tons of different mutual funds out there. There's tons of different mutual fund companies. What sets us apart from many of our competitors or other mutual fund companies in Canada is these three things here. And the first one is our open architecture sub-advisor model, which I'll speak to what that means in a moment. The other is we have a team that takes all of these ideas and puts them together in very efficient and well thought out portfolios. There's a lot of science that goes into putting together a portfolio with the optimal weights and to make it proper risk-adjusted metrics. And then we marry that, the investment side of it, with our sustainable intelligence team, who are doing the things like corporate engagement and proxy voting. So when you put all those three things together, it's something that truly is unmatched in Canada. I won't get into too much detail on what all these bubbles mean. Similar to what Matt was talking about on the private wealth side, instead of having an in-house NEI portfolio manager for the mutual funds that's deciding what stocks to buy, when to buy them, when to sell them, we have a whole team that goes out and scours the globe to try and find the best money managers in the world. And we hire them on behalf of you and our clients to run the money in the NEI portfolios. I hope that's clear. And if you have questions about that after, let me know. The other thing is, you might say, who are these companies? And you probably haven't heard of many of them. And I know this is recording, but I hadn't heard of many of them either before I joined NEI. But and that's because these managers are what we call institutional sub-advisors. So they typically run money for institutional clients. Matt gave an example of a higher net worth. So to be considered an institutional investor, you typically need about $50 million to go to one of these companies and say, hey, we want to work with you. So they're running money for big firms like pensions, endowments. We do, some of these managers run money for the Harvard Endowment. Others work with the California Public Service Pension Plan, Air Canada, Boeing, I believe, are other well-known names. So often you'll recognize the household names that these sub-advisors would be working with, but they don't typically advertise or distribute to end retail investors or people with less than $50 million. So what does all this mean? You're familiar with companies like BlackRock, Vanguard. Those are the top 2 in size money managers in the world. Amundi, just to the right of the NEI, they're number 8. And Amundi, just that one company alone, they run roughly, give or take, the same amount of money as the entire Canadian mutual fund industry. And then there's other examples of very large. So my point is with this is we're bringing you very well-established professional money managers with a proven process that have been doing this for a very long time. And combined, you can see that they run about $7 trillion, which the Canadian mutual fund industry is about $2.5 trillion. And you might say, that's great. How do I, is it time to buy Canadian equities, bonds, US equities? And everyone can help you with that. But we've also, exclusive for our credit union partners, like the team here at KCCU and KCCU Wealth, we've designed private portfolios that are designed for investors with a minimum of 100,000 investable assets. And we take all the building blocks to build a fully diversified and simple one-stop shop that's going to cover off Canadian equities, US equities, bonds. And more importantly, there's daily oversight, and they can take advantage of opportunities in the market and jump on that when the market creates opportunity. So these again are exclusively available to our credit union partners and their members. If you'd like more information on that, again, Ann and Evelyn have some stuff that they could share with you after. One other thing I'll mention as well is we also just recently put together some impact portfolios. So similar idea, one-stop shop for impact investing. So that's going to cover things like environmental, clean infrastructure, Canadian impact bonds, global impact bonds. And again, that's something that if there's questions, I can certainly help with that, but Ann and Evelyn are both experts on that as well. So I'll bring us sort of back to where we started, and I asked the question, if first and foremost you're able to achieve your financial objectives and goals, if you could make a bit of a difference along the way, hopefully I've showed you that NEI is here to help, and that we're able to marry the best of breed money managers with a proven process around responsible investing and corporate engagement. And so if this is something that you would be interested in learning more about, I'm certainly happy to answer any questions that anyone might have. But what I'll leave, this is not the Joel and Matt show. Please talk to Ann and Evelyn. They're the experts, and there's a lot of nuances and complexities about investing, financial planning, taxes, estates, responsible investing. I don't know why it had to get so complicated, but it has. So please reach out to Ann and Evelyn if you do have any questions and would like to implement some of this stuff. So
thank you so much, everybody, for coming and for listening and for asking questions. I want to thank especially but also the staff and management and the board of directors members who came out tonight to support us. Of course, thank you, gentlemen, for driving all this way and giving us your information and insights. Joel, the subject of responsible investing and ESG investing is something that Evelyn and I have had many conversations about, both in how to incorporate those things in our investment decisions, and also we've talked about the many challenges as well. So we really appreciate you coming and giving your insights. Matthew, thank you for, better read it. Thank you for your market insights, and also thank you for telling us about the product for our investors that want to get away from maybe a mutual fund in the GIC. Evelyn and I will be reaching out to many of you in the coming days to get feedback. If any of you are not clients and you'd like us to reach out to you, I have a clipboard here. Please write your name and contact information so we can reach out to you. We'd be happy to do that. And please stay and please eat. I've over-ordered. Way too much food, so eat and eat. And thanks very much for coming, and we'll see you soon.
Thanks, everybody.